Hello, everyone, and welcome to the journey to multifamily millions. I'm your host, founder and CEO of ZANA Investments, Tim Little. And on today's show, we have with us Clive Davis. Clive is a founding principal of Park Royal Capital, a firm that offers busy professionals and business owners seeking diversification beyond the stock and bond market the opportunity to privately co invest in large scale multifamily investment opportunities offering solid returns and tax benefits. Clive has been investing in and self managing his real estate investments since 1999 and is currently invested in over 2,000 multifamily doors and 317 hotel keys. After 20 years of corporate life, Clive made an entrepreneurial pivot full time into the world of commercial real estate, where he is currently focused on the acquisition, ownership, and operation of large scale multifamily communities and is a general partner with over 70 million of assets under management. Clive, welcome to the show.
Hey, Tim, how you doing? Thanks for having me on.
Yeah, and it's great to have you. So, I gave everyone a high level overview of your background, but on this show, we really like to get down to the details of how you got started on your journey to multifamily millions. So, please tell us a little bit more about yourself and what brought you into the multifamily space.
Yeah, so it's definitely been a journey, probably a 20 plus year journey in the making, at least as it relates to real estate. Let me start first with kind of what piqued my interest about real estate. And really that goes back to being a 13 or 14-year-old, accompanying my father, leaving our home in New Jersey, driving into Queens, New York, and sleeping in a sleeping bag and spending the weekend there doing painting, all kinds of handyman type repairs, wallpapering, things of that nature. Just accompanying my father, doing that for a rental property that my parents owned in Queens, New York. That was my first exposure to rental property and the fact that you could own something, some piece of real estate other than the home that you reside in. So that stayed with me and obviously influenced what I would go on to do later and what I'm doing now. So professionally, I started out right out of law school. I started out as a corporate transactional lawyer, working for a Wall Street-based firm, servicing the likes of Morgan Stanley and other investment banks and their clients in turn. So I did that for several years. Next, transition to being in-house counsel for Pfizer, which is in the news for all the right reasons these days. And they actually relocated me to Atlanta about 4 years into my time with them. I stayed on with them for an additional 2 years before transitioning yet again to become a chief compliance officer for a Belgian farmer. So all throughout what turned out to be a 20-year corporate run, I was always invested in real estate, starting back in 1999 with my first real estate investment, true real estate investment, which was the purchase of a duplex property in Cape Coral, Florida, which has, as you know, Tim, been hit pretty badly by the Hurricane Ian that recently came through. But nonetheless, that was my first investment. My parents had retired to Cape Coral in 1996. And so the idea with the investment there was this would be my way of subsidizing their retirement. I opened up a checking account. I put both my parents' names on it. I had the rents going into that checking account. And I told my parents, look, if you need anything, you don't need to come to me. Just go get it from your checking account. And so that's what I did for many years. Fortunately, I was blessed that professionally I was well compensated. So I wasn't looking to the rental income, whatever the thousand that it was probably cash flow in each month. And so all of that was able to go into that account. And again, that was my way of being the good kid, the good child, supplementing my parents' retirement. So that was my first foray into real estate investment. And I held that for 19 years. So that turned out to be a very long-term hold. I was living in New York City at the time. I self-managed. I needed some kind of on-the-ground support. I would reach out to my father and say, do you know an electrician, or give me the name of a plumber or whatever. And that's how we did it for all of that time. And fast forward to the end of 2016, which is when I said, okay, I've had a 20-year corporate run. 20 years is long enough. If you're going to get out there and explore your interest in real estate and your flirtation with being an entrepreneur, when are you going to do it? If not now, when? And so that's when I just decided that I was going to take a leap of faith and pursue real estate full time. And so one of the early things I did is I went and I bought a 5 unit property, same location, Cape Coral, Florida. And that was more of a proof of concept as to, Clive, you've been in corporate life for 20 years. Do you really want to get your hands dirty and deal with all of the issues of being a landlord? So I got renovated 1 unit. I renovated another 3 units. I had to evict a hoarder. So all of these things, the joys of landlording is what I refer to it as. But all of these things enabled me to kind of flex those muscles, test out these entrepreneurial waters a little bit more deeply. And the short story is that investment turned out to do very well for me. I bought it in April of 17, sold it 2 weeks into COVID, the end of March of 2020, did really well. And at that point, I just said, no more small multifamily. I got to figure out, how do I make the transition to large scale multifamily? And, I can get into that part of the journey too.
Yeah, thanks. And the first thing I want to say is bless your heart for self-managing for that long. I will readily admit that I did not make it that long. A lot of the same horror stories like you're talking about. A bee infestation in a bedroom, tenant arrested, another tenant arrested, tenants fighting with each other, and just all this stuff. And I decided to just go ahead and take my profits and run on that one. So good on you for doing it for that long. A tremendous amount of respect for being able to do that.
Yeah, lots of stories, but we'll save that for part 2.
Exactly. And at least you never run out of things to talk about, if you're having a drink with someone. I wanted to go back, really to the beginning. You talked about being 13 years old, 14 years old, spending time with your dad, working at those rental properties, and how that had an impact. And this is something that I try to get across to so many people, because I don't think we often appreciate how much kids are really taken in just by being present. So being able to expose them to any of these things, like I didn't have that experience myself. My dad was not, he was entrepreneurial in some ways, but not in the sense of owning properties. So I was never exposed to it. But that's one thing that I certainly try to do for my daughters when I was self-managing. For example, if I have to go in and change some lights or paint the wall or whatever it is, when I could, I brought them with me and I had them get their hands dirty. And they may not understand what it's all about at the time, but over time, those lessons start to build and that understanding starts to grow. And I think just like in your case, it all starts to make sense and it really has an impact in the long run.
Yeah. At a minimum, you're piquing their curiosity. And it's kind of like exposure to languages as a young child. You're not consciously necessarily trying to expose them to language and all of that. But when they are older and now they're starting to learn languages and they have that foundation and that early exposure, that actually, that's where you connect the dots and make the connection.
I think that's a great analogy. I hadn't even thought of it that way. And then a couple of things that you talked about, your first investment property, I thought was interesting because it was a duplex. So many times people come on and their first investment property, and it makes sense, was a single family home, whether it's the home they lived in or a home that they were able to find that they could afford to buy purely as an investment property. So I guess my first question would be, what inspired you to get a duplex vice just a single family home?
Yeah, so for me, I skipped the single family, went straight to the duplex, and it really wasn't strategic thinking at the time. It was really me taking a look around. Cape Coral, as you probably know, Tim, being closer to it, and Florida in general, there's a high prevalence of duplexes, triplexes to a small extent, and fourplexes. And so for me, when I was looking around, I said, okay, 2 for the price of 1 kind of thing at the time. And at one point, I'm trying to recall, I think at the outset, my brother was going to live in one of the units, which would allow me to live in the other, rent out the other side. And so that was also something that I was thinking that would be a way for me to ensure that he's got a place. He's also in proximity to our parents. And yeah, it was, like I said, it wasn't really strategic. It was, hey, I can get 2 units with 2 paid tenants. That's a good thing. Later, I would realize that bigger is better and scaling is better, because when you've got a single family home and you've got a problematic tenant who's not paying. You can go from 100% occupied to 0% occupied literally overnight. You can go from 100%, paid rent to zero. So it's just higher risk. And I think the bigger you can go in terms of scale, the more you're minimizing that risk. And that wasn't something I appreciated at the time, but would go on to appreciate later in my real estate journey.
No, I mean, good for you for it, like intuitively, I guess, going straight to that. With me, it was more intentional because I had made the determination, okay, I want to get into real estate, but I wanted that risk mitigation piece that you were just talking about, right? Like, hey, if one unit is rented, at least I'm getting 50% of the income, even if the other side isn't. Whereas, as you again just said, with single family, it's all or nothing, it's feast or famine. So my first one was a duplex. It's just I was living in Washington, D.C. at the time. I would have gone bigger, but I had a hard enough time finding something that I could afford in the first place. It had to go several hours outside of DC in order to find a duplex that I could afford, and wound up buying a duplex in Richmond, Virginia, which was a much more affordable area, especially the area that I bought in. And so that worked out great for me. And then, like you, I just tried to find ways to go bigger and bigger after that.
Absolutely.
All right. The other thing I wanted to talk to you about was being an entrepreneur. And I'm not as young as I used to be, but I decided too that, hey, this I got this little spark inside of me that wants to become more entrepreneurial, because I didn't want my income to be capped by someone else's decisions. I didn't want to have that risk of being let go without any warning, which I saw happen to my own wife just because of downsizing, right?
Yeah.
These are things that we can't predict sometimes. So while I think a lot of folks think that having that stable W-2 job is less risky, in some respects, it's actually not. In some respects, especially if you're a one income household, it's actually a huge amount of risk. Now, there's always pluses and minuses to the to being an entrepreneur, for sure. Lack of consistency of income and all that stuff. But I decided I wanted to do the same thing, but I felt like there was times I felt like I was too old, I guess. And I'd see these guys, millionaire by 22, and like, good for him. I wish I would have done that 20 years ago. Um, but I think you proved the point, as I hope I'm proving the point as well, that there is no age limit on pursuing entrepreneurialism, that anyone at any age can do it. Would you agree with that?
I would agree 100% with that. And I would say that like I said, end of 2016, when I asked myself that question, if not now, when, it was really, okay, I think I was 45, 46 at the time. And I was just saying, look, you've been kind of deferring this or flirting with this and putting it off. And going back to your earlier point about the risk, what I tell people today is, when you take that leap of faith and you step out and you decide to pursue that entrepreneurial pursuit, whatever it is, whether it's real estate or something else, when you have, in my case, I had a pretty solid career and credentials and experience behind me that I knew, worst case scenario, if the entrepreneurial thing didn't work out, I could go find a six-figure job and my kids were going to eat, the mortgage was going to be paid, the bills were going to be paid. We'd be okay. It may not be the job that I'm passionate about, that I'm, can't wait to tell stories about, but I was going to handle business regardless. And so I made corporate life and a corporate W-2 job my backup plan, my safety net in case the entrepreneurial thing didn't work out. And so anyone who's in corporate life today and they feel like they're stuck there, what I would say to them is, that's a very risky situation, especially if you are a single income home, which I was at the time. And, it's actually more risky to have 100% reliance on that and to never have kind of ventured out and pursued something that you may turn out to be, destined to do that thing, but your fear holds you back from stepping out and taking that leap of faith. And so it's really reimagining or rethinking what risk is in your life.
Yeah, and I think you brought up a good point that we should probably emphasize. Not saying, if you're just starting out, drop everything and go entrepreneurial. And the people who probably see the most success are the ones who have that backup plan in case all goes wrong, right? And I'm in the same situation you are. I'm confident that I could go out and get a six-figure W-2 job if I had to, but I don't want to. So
Agreed.
so right now I'm trying to build up the business. I have about a 2-year timeline to build up the business to where I'm getting somewhat consistent income, or to it's where it's a point where it's, starting to bring in what I need. But if all doesn't go well, I could still go out and get that W-2 job. And even those deals that I've started, they're not going to go anywhere. I just may not have as much time to devote to them as I do now, where I could be heavily involved on the asset management side of things and so forth. So yeah, I think that's huge again in terms of risk mitigation, is knowing that you have that backup plan if you're going to pursue real estate investing full time as an active syndicator. And going into that, that's a good segue into one of the questions I had. As someone who's made that transition from that successful corporate job into being a real estate investor full time, what were some of the things that kind of surprised you in terms of um, maybe they were easier or harder than you had expected when you first started going into that transition?
Yeah, there are definitely a few surprises and a few things that I had to adjust to. First thing that you have to adjust to is no longer getting that direct deposit that is hidden every other week. So that's a big adjustment. You go 20 years of your life and you have that kind of consistency in your life, and then all of a sudden you don't have that direct deposit. That really can be a stimulus for you to get your stuff together and fully commit. So that was one adjustment. And I tell people that from the age of 18, since I was 17, 18 years old, I had never been in a position where I had more money leaving my household than was coming into my household on a monthly basis. And so that can be very disconcerting because you're used to, being able to pay your bills and hopefully more money's coming in than is leaving on a monthly basis. That's what that's the position everyone wants to be in. So that was the first kind of adjustment and reality that I hadn't quite prepared myself for what that feels like. And that's a psychological kind of mindset thing that you have to get comfortable with. So that was one adjustment. The other thing, simple thing like refinancing my personal home or buying a single family home, when you do not have a W-2, while it can be done, it's just a lot more cumbersome to do because, Tim, the first two things they ask for when you walk into a bank or a lender is 2 years of tax returns and pay stubs for the last 30 days. And when you tell them, I don't have a W-2, I don't have pay stubs, they'll ask you for the same thing, just two or three other ways, because that does not compute for them because they have a very, tight box and matrix as to, what they want you to jump through, the hoops they want you to step through and hurdles they want you to jump over. So I tell people that if you are making that transition, definitely give thought to, do you want to refinance your home, get that squared away before? Is there, are you anticipating a transition from one home to another? All of those things that are within your control while you are gainfully employed with that W-2, try and take care of them before you step into that entrepreneurial journey in full. And I jokingly tell people today, it's easier for me to go buy a $30 million, $40 million property than it is to even refinance my own single family home. And people, they're like, what are you talking about? And I tell them that what I just shared with you is that, if you don't have a W-2, you're looked at almost as if you're good for nothing in the traditional banking world when it comes to buying a single family home or refining it. Whereas in the commercial world, which is 5 units and above, and part of the reason that I bought that 5 unit is kind of the first thing that I did is when I bought that 5 unit, I don't even think they asked me what I did for a living. They definitely didn't ask me for a W-2. All I needed to worry about is can I show up at closing with the requisite amount that I need to close the deal? So my down payment, my miscellaneous costs, do I have any funds that I'm going to need to renovate the units? But I don't recall anyone asking me what I did. Their focus was on the commercial property, which is a business, and that's the way they're looking at it, and it's the way that we should be looking at it. So their focus is on, this is a business, it generates a certain amount of revenue today, and these are the things that the buyer is going to do, which should hopefully increase that revenue to, whatever, 1.2, 1.25, whatever it is. And they make their determination based on that. And then they look at you as a borrower secondarily. Have you gone through bankruptcy? Are there any red flags we need to be concerned about? And then obviously, got to show up at closing with the funds. Otherwise, you're just wasting everyone's time. But assuming you can, again, your W-2 becomes irrelevant. Had I bought a 4-unit, 3, 2, or 1, I would have went through all of those hoops and hurdles that I alluded to.
Yeah, and I think it's probably counterintuitive to a lot of people who are unfamiliar with the space when you tell them like, hey, most of these loans that I do for these, multi-million dollar properties are non-recourse. What does that mean? That means they won't go after me and my house and my car and my dog. If the mortgage doesn't get paid, they just take the property back because like you said, it's a business. And that's usually only the case if it's $1 million or more, which again might be counterintuitive to people. They're like, wait, the more expensive it is, the less liability is on the person that's borrowing. But that is the case on this side of things. So you're absolutely right. It could be a lot easier in theory to buy these multi-million dollar large apartment buildings than it is to buy a single family home. So that's funny because my wife and I have talked about that as well, perhaps moving back to Colorado, but we need to take that into consideration. Like, yeah, she is a W-2, but I don't. So our bank's just going to look at me like I'm a scrub. Like, no, I don't have a monthly income, but look, I got this big chunk of money 6 months ago, and I'll probably get another big chunk of money in a year or whatever it is. So I think part of what you talked about too really alludes to making a plan. If you're serious about doing this, have a plan, for things like you said. Are you going to refinance your home? Any huge purchases? If you know what your budget is, then set aside some of that cash while you still do have that steady W-2 and sock that away for whatever parts of the budget you were responsible for. That's what I did, saved up whatever it was, 40,000. So that I could say, hey, for the next 2 years, those things that I was already paying for, I will continue to pay from the money that's in the bank account. So nothing will change from that perspective. And that gives that more peace of mind aspect as you try to build up your business. Because like you said, you see a lot of money going out, but until, you get an acquisition fee or until a property goes full cycle, you're not seeing a whole lot of money coming in.
Yep, absolutely.
All right. So we talked a lot about your entrepreneurial journey, but I do want to hear more about how you kind of scaled up. Yeah, we talked about that 5-unit. Can you tell me a little bit more about how you went from there to those much larger deals, when you told yourself no more small deals?
Yeah, so there's definitely some story between the 5 units and the first 244 unit. So one of the things I did in 2017, a few months after leaving, is I decided I didn't want to leave my retirement funds in the stock market. And so at that point, I had 2 legacy 401ks that I could either leave with the former employer, roll it into a generic Fidelity or Schwab or whatever account, IRA, or what I learned about attending some real estate conference, I learned about self-directed IRAs and the opportunity to roll those funds into that, take 100% control of my investments of my retirement dollars. I no longer had the excuse of I'm too busy to learn this, to focus on this, just turn it over to someone and just kind of let it roll. And so I was very deliberate about, okay, I'm not going to do that. I have no excuse now. I can take control of it. And so the self-directed IRA allows you to pretty much invest. There are probably only one or two things that you cannot invest in. I think 60, 70% of self-directed IRA funds are deployed in commercial real estate. And then, I've heard of people investing in thoroughbred horses and the semen of thoroughbred horses and all kinds of things, art and what have you. But that wasn't my path. I knew I wanted to get into commercial real estate, and I was confident about that space. And so I said, I'm much more confident about this space than I am about the stock market. And so I'm going to kind of put my money literally where my mouth is. And so I invested in probably 11 or 12 deals passively. And these were deals that were with institutional quality sponsors. And my approach was, I'm going to invest in the types of deals that I aspire to do in 1 to 2 years once I kind of learn the ropes. And so most of those investments were via a crowdsourced platform. And that includes ground up development of multifamily, traditional existing multifamily. And then I also invested from a diversification standpoint in a portfolio of hotels here in Atlanta, all of them within 25, 30 minutes of me. And so beyond kind of the ROI I expected from those investments, now any money coming back is not coming back to me. It's going back into the self-directed IRA. So it's still part of your retirement. So cash flow wasn't key to me. Appreciation was probably more important to me as I was thinking about those early investments. But I got a ton of education beyond the ROI. So you get to see, how do these institutional quality sponsors put these deals together? What do their business plans look like? What do investor relations look like? So all of the things that you're going to need to know when you step into the shoes of being a sponsor of your own deals and sharing those opportunities with people, I was learning as a kind of a byproduct of being a passive investor in these deals. So the next thing that I did is I said, I've got to surround myself with people who are like-minded, who are further along in their journey than I am. And so I sought out mentorship. So I ended up signing up with an apartment investing mentoring program at the end of 2018. I submitted my first offer on a deal, big deal to me at the time. It was 92 units here in Atlanta. We ultimately didn't get it. We were runners up. One guy beat us out. I said, no biggie. I'll find something a month or two from now. And fast forward, ultimately, I'm not an overnight success. It took me the better part of 2 years before I landed the first big deal. And that was the 244 unit that we were awarded in summer of 21, closed it in Q4, acquired it for 30 million, raised 8.25 million in equity. That same week that we got that deal closed, we were awarded a 200 unit, $40 million deal that same week. So there are various folks out there who talk about the law of the first deal. Michael Blanc is one of them. And I'd heard it in theory, but I actually ended up living that and experiencing that, because I was knocking on doors for 2 years, underwriting, submitting LOI, best and final, runners up, bridesmaid, but never the bride. I finally got that first deal, which was a big deal to me. And then literally within the week of closing that one, got awarded the second one. So going from 0 to 1 is the hardest deal that any of us will ever do. And then deals 2, 3, and subsequent, those tend to be easier and come quicker than your first one does. And that was my experience.
Wow. Yeah. I mean, at first, I think I would say I'd probably be terrified if I had 2 deals of that size at the same time, just in terms of the work that goes into it up at the front, and then, the raise aspect. So that would be a little intimidating, but I guess it's one of those good problems to have, right?
Definitely a good problem to have. And the one thing that you'll learn, and Tim, it's a team sport, right? So I'm not out there buying 30 million, 40 million deals by myself based on my balance sheet. In my case, I have 3 primary partners, the same 3 primary partners on both of those 2 deals that I mentioned. And so we're coming together. Everyone's kind of playing their role, playing their position. All of us have a responsibility for raising capital in addition to our, kind of specific roles beyond that. And you come together and then you bring in your respective networks and you get the deal done that way. But it's definitely not a solo entrepreneurial pursuit.
Yeah, and I think you brought up some good lessons for passive investors there. A lot of people are not even aware that the self-directed IRA piece is an option. I actually just had my monthly live webinar on this last week and had some solo 401k expert on to talk about this and answer the questions because I think it's so important that people learn about it, not just because I want them to have the same opportunities that I do, but just because I feel like again, I tell people it's almost like this black box that people don't know is there until they trip over it. And then they find out, like, oh, so I can do what I want with my own money, those retirement funds. And so, like you, I had an orphaned solo 401k from one of my previous jobs. And so when I found out I could put it into real estate, I mean, guess what? I put it into real estate and I've had success with that so far. I have not as many deals as you did, but mine was probably smaller at the time. So went full cycle on one, put it in another, and then even did hard money lending with the money that was in my solo 401k. And people just aren't aware of the creativity. Like you said, you can get into some pretty weird stuff, crypto, horses,
Yeah.
etc. But for those who are looking to have more assets to invest in something like real estate, they might have it and not even know it because they just don't have control of those funds that are available to them.
Yeah. And there's good reason that very few of us know about self-directed IRAs or solo 401k. And I think Wall Street has worked hard to keep us ignorant of these alternatives. But when you look at what's happened, I look at kind of the Dow Jones, which was at like 37,000 a year ago. And I don't know where it is today. It's probably down 29,000. It's dropped by about a quarter or somewhere plus or minus of that. And so if you've got all of your money, 60% here, 30% here, 10% here, and it's just riding the stock market wave up and down, I just think that there's really an opportunity. You really need it's incumbent upon you to explore diversification. One thing Wall Street does tell you is to be diversified. And I would say part of that diversification is diversifying away from having all of your investments in the stock market.
Absolutely. I joke that, on Wall Street, when they say diversification, they just mean different stock. But you're right. Into different assets is true diversification because then you're not subject to the same fluctuation. If one is going up, maybe the other one is staying steady. And if one is going down, then maybe the other one's going up. So that's what true diversification is. And more people need to practice that. But as you mentioned, Wall Street has put probably billions of dollars into convincing most people that the only thing they can choose from is fund A, B, C, D, E, and F within their retirement plan. And no, you absolutely cannot take it anywhere else. That's not allowed. So it's good to see that other people are spreading the good word about that too. All right, that's a great segue, I think, for us to go into our turbo round. So I'm going to ask you 3 questions that I ask all of my guests in quick succession so I can get your thoughts. The first one, what is one red flag every investor should look out for? And that can be either passive or active investor.
There are lots of them. The one I would point to is a sponsor who is not hyper transparent.
Agreed. Yeah, transparency, it should be all of our watchwords. That should be the first thing, because the minute a sponsor hesitates or refuses or is reluctant to provide information, that in and of itself, I think, should be a red flag, right? It's your money they're doing with it, and you should be privy to know.
Yep, I agree.
All right, the next one. What is a myth about this business that you would like to set straight?
A myth about this business, especially folks who are further away from it, is that you've got to have tons of money. You got to have 7 figures to even be playing in this space, and not for the average man or the average woman. And so that's a big myth that keeps a lot of us, frankly, from ever kind of taking the leap of faith and pursuing these types of opportunities. Because if we don't come from that, we just assume that's not for me. And that's a total myth.
Right. I'll readily admit I was in that same boat. I was pursuing a small multifamily, single family kind of route to wealth, I guess, because I couldn't wrap my brain around that even being an option, investing in these large apartment buildings. I just assumed, like most people do, I think, that that's big money, you know, huge firms, Goldman Sachs, whoever that's buying all these things up, and you couldn't possibly get into it as a normal person.
Yeah.
So yeah, that's huge. All right, and the last question, what does success look like to you?
So success for me is, it's all about independence and freedom. So I won't curse, but I routinely talk about having FU money. And for me, FU money is money that enables you to do what you want to do, when you want to do it, with whoever you want to do it with. And so it's all about freedom. But beyond kind of freedom that kind of financial success brings to you, for me, success really involves being able to impact people beyond my family, within my community, kind of as far as my reach can extend. And so I would say, obviously, the financial success is a piece of it, but just as important to me is the ability to impact people. And that impact may just be showing people, sharing my journey and showing them how it's possible for them to get on the same path.
Yeah, that's a great message. I couldn't agree more. And that's why we're here. That's why we're on this podcast. Hopefully someone will listen, and maybe, just maybe, that changes their life. All right, Clive. Hey, this has been great. Please tell our guests how they can get a hold of you, and if you have anything else that you would like to share with them.
Sure. So I'm active on social media. So you can find me on LinkedIn, you can find me on Instagram, all of those things. But the best way to find me is via my website, parkroyalcapital.com. If you go there, you're going to find everything you want to know and see about me. You can book a call with me if you want to kind of continue the conversation and have a discussion about real estate and my journey. Happy to do that. So go to www.parkroyalcapital.com.
Great. And we'll definitely have that information in the show notes for everybody. I want to thank you again. This has been an awesome conversation. I appreciate you coming on, and I look forward to seeing you do big things on your journey to multifamily millions.